We have touched a bit of technical analysis. Let's go to fundamental analysis. While technical analysis is about the what of the market, what the price is doing, fundamental analysis is about why, that is the why of the market, why the price is moving. Currencies are valued based on the health of their respective economies. 1. The economic calendar. This is your best friend for fundamental analysis. It lists scheduled news releases like inflation reports, CPI, unemployment rates, and the GDP data that can cause massive volatility. Never trade into a major news event without a plan. For you to trade a news, be careful. Number 2, central banks and interest rates. Central banks like the US Federal Reserve or the Fed control monetary policy primarily through interest rates. If a central bank hikes rates, it typically makes that currency more attractive as investors get a higher return, causing the currency's value to rise. This is the biggest fundamental driver. You have to take note of this, it's critical. Number 3, geopolitical events. Wars, elections, trade agreements, and even major political speeches can cause unexpected currency fluctuations. Let's talk about risk management and trading psychology. The risk capital and the 1% rule. This is arguably the most important section of this entire tutorial. If you have to miss anything, don't miss out on this part. Trading is a game of risk management, not prediction. You cannot control the market, but you can control your exposure to it. You cannot control the market, but you can control how much of your money you expose in this market. First, the risk capital rule. Only trade with funds you can genuinely afford to lose. This money should not be tied to your bills, rent, or future savings. It should be money you are ready to let go. Second, the 1% rule. Never ever risk more than 1% of your total trading account balance on any single trade. If you have a $5,000 account, your maximum loss on any one trade should be $50. This protects you from catastrophic loss and allows you to survive a long losing streak. With this, you can trade like 100 times before you blow up an account. Now let's talk about calculating position size. Because we are talking on how to maximize our trading potentials, we are talking risk, and to understand risk, we must know how to calculate the 1% we are talking about. The 1% rule connects directly to your position size, the number of lots you trade. You must use a position size calculator every time you trade. The formula is you must determine your stop loss distance in pips, and the calculator tells you exactly how many micro, mini, or standard loss to use, so that if your stop loss is hit, you only lose 1% of your account. So this calculator is going to help you that at any point you lose, you are losing just 1%. This is non-negotiable. If you don't calculate your position size, you're gambling. You're just trying to let me see what happens. And Forex doesn't hear that. It does not understand that. It will shock you. Now let's talk risk management and trading psychology. Let's talk about risk to reward. RR. You must have heard of that. Risk to reward. The risk to reward, or RR, is the single most important metric for consistent long-term profitability. It measures how much you are risking versus how much you stand to gain on a trade. So you are here determining how much you want to risk on a trade and how much you intend to win if it goes in your favor. If you reach 50 pips, your stop loss distance, to gain 100 pips profit distance, you have a 1:2 risk to reward ratio. This means you are aiming to make twice as much as you are risking. Why is this so powerful and helpful? You do not need to win every trade to be profitable. With a 1:2 RR, you only need to win 34% of your trades to break even after factoring in costs. Aiming for a minimum of 1 to 1.5 or 1.2 is standard for professional traders. Good risk to reward protects you from the emotional damage of losses, because you know that, you lose one, you might win the next one, and that is going to cover up for the one loss. Now let's talk trading psychology. And this is also a powerful point we have to understand before we ever get trading. Forex trading is 80% psychology. The market is designed to exploit two human emotions. One, fear, and the second, greed. Fear often causes traders to cut winning trades too early because they are afraid the profit would disappear, or to hold on to losing trades too long, hoping the price will turn around. Like, wait, let me wait, it will turn. But this violates their stop losses over a long period of time, causing them to lose the trade. Greed often causes traders to over-leverage or overtrade, placing too many trades after a win, thinking they can't lose. This is a part of blowing up your account. Or being afraid to not taking much trades again. The solution is discipline. Follow your plan. Accept that losses are part of the game. Know that trading is a business and not a casino. And this will lead us to talking about trading plan. You have to get a plan. And that's why we'll cover much later in this video, mechanical trading, so that at every point in time you are trading like a boat. You already have your plans put in place. So a trading plan is a detailed written document that outlines exactly how you will approach this market. This is your business manifesto, and it's like your trading tenets, and you must stick to it religiously. It must include 1. Markets. What currency pairs will you trade? 2. Time frame. Will you use the 1 hour time frame or the 4-hour chart? 3. Entry. What specific technical conditions, e.g. price hits support and RSI is oversold, must be met before you enter? Then plan your exit route. Then number 5, plan your profit management, and always follow the 1% rule. If a potential trade doesn't tick every box in your plan, you do not take the trade. Your plan is your fortress against emotions. Because the moment you derail from your plumb line, which is your trading plan, you are going to act with no guide. So let's talk about the practical steps and the routine you have to put in place in your trading. Now, how does a consistent trader operate day to day with a routine? How? How do you do that? We have morning routine. Check the economic calendar for major news, which I'll drop the link to the economic calendar. Review your choosing charts on a higher time frame, like 4-hour or daily, to determine the overall trend. Just like we said earlier, trend is your friend. Identify key support and resistance levels. In our case, we'll talk about demand and supply. We'll dive deeper later. The trading journal. This is your accountability partner. You must log every single trade, win or loss, including screenshots and reasons for entry and what you did right or wrong. The only way to improve is by analyzing your past performance and spot recurring mistakes or successful patterns. So this way you can analyze and predict yourself, and then help to correct and show improvement. Developing a strategy and backtesting. We have to backtest on our trading demo. We briefly touched on common styles. As beginner, focus on learning one of these proven strategies. 1. Trend following. Only trade in the direction of the trend. For now, just follow the trend. Buying uptrends, selling downtrends. Your rules involve finding a pullback to a key support or resistance, in our case demand and supply level, with the existing trend. Number 2, breakout trading. Waiting for the price to forcefully break out of an established consolidation range or a support and resistance level and entering the trade in the direction of the back breakout, right? But in our case, we're not talking breakout, we are talking break of structure, BOS. We'll dive deeper later. Before you use any strategy, you must backtest it. Use your charting platform to look at historical data and see how your rules would have performed over the last 100 trades. If you have not backtested up to 100 trades, don't trade. If it wasn't profitable historically, it won't be profitable in the future. So if you backtest and you take 100 trades, you aren't successful, then the chances of you not surviving in real trading does not exist. Conclusion. You now have a complete 360-degree view of what it takes to start Forex trading. We've covered the language, the tools, the platforms, the analysis, and most importantly, the risk management. Your next steps are clear. Number 1, choose a regulated broker. Number 2, open a demo account, demo your trades. Number 3, dedicate yourself to consistent practice and journaling. Number 4, stick to the 1% risk rule. And then patience and consistency are your two greatest allies. Don't chase the quick money, chase the consistent growth. If you found this tutorial valuable, please like and subscribe for more in-depth content. Good luck, trade safe, and I'll see you in the next one. Peace out.